Try this again. Good morning, everyone. Can you hear me? This is Joseph Trevisani from Worldwide Markets. Technology will out. My apologies, folks. I do not exactly know what happened, but it is clearly fixed. Now we can proceed with our webinar. My apologies again. Perhaps it's because I predate all of this web technology. Who knows? Anyway, thank you for being patient. We do have a rather fascinating topic this morning. I could not ask for a better illustration of my topic, and for some reason, circumstances, the gods, if you will, have complied. The chart you're looking at is a chart of Euro-Swiss. For the past 2.5 or 3 years, the Swiss bank, the Swiss National Bank, the SNB, had pegged Euro-Swiss. Needless to say, Switzerland does most of its trading, the majority of its trading with the Eurozone. It is an island of non-Euro in a Euro sea with the Eurozone. And it had pegged its currency, the Swiss franc, at 1.20. Yes, I can manage it. I will rush through it. I apologize, but I think we can manage this. I'm going to go a little far astray, just a couple of items here. I think probably to illustrate both the way markets work, to share some of my experiences. I have sat on trading desks through this, through moves like this, and I'd like to explain exactly how it works. The charts don't really give you a flavor of what is actually happening, and what you see delivered as information on your trading system is on, and I'll explain what I mean in a minute. On top of that, as we always do, if anyone has any questions, comments, considerations, or anything else, including jokes, please type them in, and I will be glad to stop and retell the joke if I can make it better, or anything else. I much prefer that this be, as I often say, a colloquium rather than a lecture. So this morning at 4:30, after having yesterday said, I think two of the members of the Swiss National Bank were out yesterday saying that they're going to keep the peg. They came out and dropped the peg today. Now, those two guys who spoke, I think it was two of them, who spoke yesterday had to know what was going on, and they absolutely set up the market for this. One thing central bankers dislike are currency traders. Those who have different opinions. Yes, we can all thank Mr. Jordan very much for his glorious application of volatility and you might say the principle of chance to the currency markets. A phenomenal move, which what I have up here and I'm going to go through first is a tick chart. Anyway, a little background, as you all know, the SNB had pegged the Swiss franc at 1.2. The reason they had it pegged there is because they didn't want it to get any stronger. And for all that's been going on in Euro and in Euroland and the world for the past couple of years, there are periodic bouts, as we're seeing again now, of safe haven. Every once in a while, something happens, as is happening now. People are now concerned about the world economy. And what are they doing? They are buying treasuries in the United States. They are buying treasuries or bunds in Germany and other places because they're worried about what's going on. They are buying Swiss assets. They're buying Swiss francs. What happens when you buy a currency? We all know it gets much stronger. So the Swiss National Bank did not want that. It's tough for their exports. Might be good for their financial system, but it's tough for their exports. So they attempted to hold the line at 1.2 to the euro. The problem is, this is the problem. Where's my euro chart? This is the problem. That's a euro dollar chart. The euro, since the middle of last year, has been getting appreciably weaker. If the euro is getting weaker, then that makes it much more difficult for the Swiss National Bank to keep its peg. Now, this is reminiscent of the glory days of Mr. George Soros against the Bank of England. And when the ERM, at the same time, the ERM, the peg for the European rate mechanism, was also being attacked right, left, and center by currency traders, or as they're referred to in the media, generally currency speculators. Same thing, and they serve a purpose, besides the trading purpose for all of us, which is to make money. And that is to bring some rationality to the financial system with their own risk. It has been increasingly untenable for the Swiss National Bank to buy enough euros to keep the peg. So, what did they do? They dropped it completely unexpectedly. And this is a tick chart that we're looking at. That means it records prices. So we have 1, 2, 3, 4, 5. This is on the Bloomberg system. 5 prices. 5 prices from, it doesn't tell you how many times it traded at each price, but I didn't bring a minute chart, but I'll show you a 5-minute chart. From 120 to 85. That is, if you'll pardon me, one heck of a move. Now, what was really going on in the markets? Remember, systems like ours and like most retail trading systems show prices. Although I've been told, I haven't verified, some other systems simply stopped showing prices in some of the currencies that were moving so much for a couple of minute period there. So what they do, what happens in the markets? Remember, our system gets its prices and its price information from the top level systems, which is the EBS and Reuters, where the banks submit their own bids and offers, and that's what constitutes the market. The market is a voluntary price submission model. That means if no one puts in a price to the EBS, the bank system, then there are no prices. Or if they put in a price that's 2 figures wide or 3 figures wide or 5 figures wide, which I have done in the old days when I was sitting on those bank trading desks. I worked for Credit Suisse for 15 years, both in New York and in Singapore, from the late 80s until about 2000, and also the Bank of Bermuda. And my job, one of my jobs when I was there, was to make prices for the market. That's what traders did in those days. It's a little different now, but the principle's the same. What has happened in this chart, what you're looking at on this chart, is essentially there were no prices. Nobody had any idea where this was going to go. But the driver was orders. Most likely, there were banks out there who had orders to sell Euro Swiss. And also some of the other currencies. And we'll take a look at them. Euro, dollar Swiss, even dollar yen. Which may or may not, the Euro Swiss orders, of course, were related, obviously, to the Euro Swiss. Sell orders in the euro, not necessarily related. Let's take a look at the euro. What happened to the euro? Tick chart of the euro. Whoa! Fun and games. 117.50 to 115.75. A big move, not an unprecedented move by any means in the euro. The move in the Euro Swiss, I will say, is unprecedented, certainly in that cross. But one of the things that would help to drive the Euro Swiss, of course, is a collapsing euro. And to be sure, as you got through, this is a tick chart. I'll show you the 5-minute charts in a minute. As you started to run through these levels here, orders, stop-loss selling orders, were piling into the euro. And so you have both a catalyst from the euro and you have it piling back in from the euro. But primarily, especially in the euro Swiss, what happened is prices, bids disappeared. We show a price. Variable price systems, where they widen out the spreads, which is what happened on most of those systems, they show a price. In the real market, or not in the real market, because these are all the real markets. If you complete a deal, it's a real market. In the interbank market, to be sure, prices disappeared for a time. There was no bid. There was no floor. Now, if I were sitting on a bank desk and I had Euro Swiss orders, and you know, the Euro Swiss has been comatose because of the peg for 3 years. And when there's no volatility in a currency, what happens? Currency traders go elsewhere because there's no point in trading a currency that's pegged. Were there people going short the Swiss franc, the Euro-Swiss cross? I can't answer that. I can't think of any particular reason that they would be, except the logic. Ever since the summer, the currency logic was totally on their side. Currency traders have, I think, a career path of about 10 years in the interbank markets. That's about how I lost it, about 12, 15. And the last couple as a prop trader out of Bermuda. But the logic, the economic logic, was all on the side of anyone who was willing to short the Euro-Swiss. And the reason is simple. The reason is the collapse in the euro, but not only the collapse in the euro, I'll deal with that in a second. It would be a very good move, wouldn't it? Yeah, I guess so. I'll talk that in a second. This is the logic behind what the Swiss bank did. What is the timing? My guess, if the euro is going down, and the euro has been going down appreciably and hard since the summer, and I think the euro will go a bit further depending on what the ECB does on the 22nd. Mr. Draghi has been talking about buying sovereign debt, quantitative easing, becoming the new Bernanke, or you will, the new Federal Reserve. There's been a lot of doubt that he can pull that off, that the Germans will permit it. I think they probably will at this point. And why today? So as the euro is collapsing, it becomes harder and harder and more expensive for the Swiss National Bank to continue to thwart the appreciation of its own currency. I am sure, I don't know who they are, that there were knowledgeable currency traders, maybe not with as high a profile as Mr. Soros, who seems to like, not seems to, who likes the limelight very much and has since moved on to other endeavors. But because not only is the logic there, but the history of the European attempts to prevent this kind of appreciation have all failed. The ERM collapsed. The Bank of England had to pull out because markets can always, when they are in opposition to central bank policy, overwhelm the central banks. There is simply far more volume going through on the speculative side that can ever be handled by a central bank. The only time central banks are successful, such as the Bank of Japan, as we've seen over the past 2 years, is when they abet what the market is willing to do, not when they are attempting to prevent it. So although I have seen very little in the currency press, if you will, in the financial press, about currency traders, and I'm thinking hedge funds, and there's somebody, in my guess, made a great deal of money today. I don't know who they are, but somebody did. If you can go back, it would be interesting to go back through when the BIS comes out with their statistics, and they will divide up, I believe they divide up by currencies, and to look at who or how much volume was going through the Euro-Swiss cross in the run-up to this particular move. So there are people out there who were selling, and who were they selling? They're essentially selling against the SNB. So yes, now to talk to your question. In order to support the currency peg, what does the SNB have to do? It would have to buy euros and sell Swiss francs. So my guess is that the SNB lost a lot of money on this. because not only is the Swiss higher, but the euro is lower. And did they suddenly turn around in the morning before and start unloading all their positions? It's possible. I doubt it. I don't know that there'll ever be an answer to that. I doubt that the SNB came out and shorted the euro Swiss. I'm not saying it's impossible, but I doubt it. Central banks don't usually work that way. Okay, so back to the market action here. Now, this chart, as I said, is the greatest indicator and precursor of what we saw today. Why did we see it today? Again, I will speculate. I will guess. This is not only my idea. This is also, I think Goldman came out with this at some point today, too. Let's put up the Euro Swiss again. That's the Euro Swiss. Their take on this, and I would agree with this, is that next week's meeting of the ECB, not only are they going to finally announce something of their quantitative easing program, buying some type of sovereign debt purchase program. A lot more difficult to do it in Europe than it was in the United States, but something. At this point, they really don't have any choice because they have spoken about it for so long. The other idea, and this is Goldman's idea, and I agree with this, is that they are going to announce a much larger program than the market anticipates. I think probably the market anticipates probably about €500 million. I'm 500 million euros, sorry. 500 billion euro, my apologies. Whether that actually comes through or not, we don't know. But for them, for the SNB to make this move now, seems to indicate that something is pending next week with the euro and with the ECB. And so to get ahead of it, to get it out of the way and not be crushed at the time, the SNB made their move today. Okay, so now what happens, as I said, when something like this takes place? If you're sitting on a bank desk at 4:30 in the morning, you were not expecting this. You have an order book. Considering what's going on in the Euro Swiss, it might not be much of an order book. On the other hand, it might. I don't know. Given the history, given the knowledge of what happens when central banks attempt to do this, given the experience, there are still a few people around the currency markets in positions of authority on bank desks who remember the ERM, who remember George Soros and the Bank of England and what happens. For those people, this is a golden opportunity. And so there were probably two types of orders. There were established short positions in the Euro Swiss, established over what period of time, I don't really know. And there were stop loss orders below. Now, the stop loss orders below are the dicey part. No bank will execute without a price. So if I'm sitting on a Swiss desk and I have a stop loss order to sell 50 million euro at 1.15, I need a bid. This morning, there weren't any bids. Let's take a look at the 5-minute chart in the Euro Swiss. Where's my Euro Swiss chart? Here it is. Sorry. Come on, computer. Well, these wireless mice can be a little dicey. Okay, this is the 5-minute chart in the Euro Swiss. So from 1.2 to 0.85, we have 5, 10, 15, 20 minutes. 20 minutes of, shall we say, angst, nervousness, and moreover, more than anything else, sheer panic. If you are sitting on a trading desk and you have the responsibility for that Euro Swiss book, which I used to trade Mark Swiss, which is the same thing. You at 1.15 are suddenly long 50 million euro. Do you know how much money you can lose as a trader on 50 million euro when it goes from 1.15 to 0.85? That's a whole lot of P&L. And these days, that's several years of P&L. So what do you do with that particular position? Nowadays, you go out, well, as a principle, you sell it as quickly as possible. You may even, as the market started to move, try to get in front of it. But chances are there were no bids in the market. That's why you got to move like this. The only bids that were likely to be in the market were perhaps people had left resting orders and they were being executed. There were no bids relating to the intraday back and forth of currency markets. That's also why you have this tremendous fall and then the huge run back up. This is a wild one. I am sure that some traders out there held on to I've done this myself, but you got to do it when you're young because, man, it's tough when you get older. I'm sure not being able to sell, they simply held on to the position. So from 115, down to 85 and back, but it's only 20 minutes. Those are a long 20 minutes. So for everyone participating in the markets, what you must remember from all of the information that the systems are giving you, the reality behind those systems is that there were no prices in the market, or very, very, very few. And if you completed a deal, and for the bank traders, if they have an order at 115, they might have written that 5 figures away. I certainly would have. In situations like this, you go for your execution write-up. So if somebody wants to sell 50 million euro at 1.15 and it's not just crashing, it is the currency's gone into a black hole. It's like a end of one of those Star Trek movies where they're all going into the black hole, and they always come out the other side. And Swiss has come out the other side as well. What you do is you write it at the next price. So in a case like this, if we go back to look at the tick chart, okay, you have an order at 115. There might have been a price somewhere around here, 110. So you would actually write that order, and then you'd get screams from the customer, of course, and from the sales desk, which is in charge of the customer book, and the customer relationship. You're in charge of the book as the trader. But these are very unusual circumstances, but they are fun, or at least they're fun in retrospect, or they're fun if you survive them. I hope nobody lost their jobs over this today, but I mean, there's going to be, in a situation like this, enormous losses. I mean, Dennis Gartman was on, I think, CNBC this morning, talking about how all these unnecessary losses were inflicted on the markets by the SNB. And yes, there were a lot of losses inflicted on the markets and also a lot of profits inflicted on the markets from the SNB. But the idea of unnecessary seems kind of gratuitous. If you play in these markets and you play in large amounts, then the risk that you undertake are part of the game, a part of the deal. And if you get blindsided by something like this, well, so be it. There's not much you can do about it. Okay, so having been through a situation like this, you have to run with what you are given. The topic today was the intersection between fundamental analysis and technical analysis. Today is a grandstand example of fundamental analysis, but it's not the type that is. That's correct. I'll deal with that in a second. You're absolutely right. But it's not the type. This is a fundamental change. So it certainly doesn't come under technical analysis. But in a sense, it doesn't really come under fundamental analysis either. This is not an economic change, it's a policy change. It's not one which could have been predicted. Although, of course, in retrospect, it now seems eminently logical. And if you will, at some point, predictable. If it's true, and I think it is, that the ECB is going to do something which will probably take the euro even lower, then this is a very logical and predictable move at some point, because I find it fascinating. But this, I felt, was too good a chance to pass up, because I know that one of the things that happens from a retail point of view is that there's a bit of mystery about where the prices come from, what generates them, why you get this kind of move, and how it relates to your own positions, pricing, and the way you view the market. And that's what I'm trying to elucidate here, is that behind the interbank market are men and women sitting on trading desks, just like us, with different responsibilities, but dealing with the same type of inputs, of lack of knowledge, of fear, if you will, and of a need to execute and be professional. Behind that chart are real people. People sitting on trading desks, people whom I know, people whom I used to know, whom I used to be one of. And their actions, some of them voluntary and some of them forced by their own order books. No, that's not the way it actually works. If I understand what you mean correctly, what I was looking at is this chart here. Okay, this. Let me give you the 5-minute chart in the Euro Swiss. Okay, this is the Euro Swiss 5-minute chart. So this is a record on Bloomberg of the prices that went through the price action from the time of the announcement until it touched the bottom. Each one of these candles is 5 minutes. So 5, 10, 15, it's 20 minutes essentially. But that doesn't have anything to do with the amount of volume that went through the world currency markets in this 20-minute period. I don't have any idea how much went through. It's my guess that the liquidity was very limited. What you see are prices. What you do not see is trading volume. And there really is no clearinghouse for volume information in foreign exchange. So I don't know how much volume went through. The 500 that I was talking about has to do with what the ECB may or may not be doing in its quantitative easing announcement whenever it comes next week, how much money they're going to do. That has to do with what the market anticipates the amount is going to be and what they actually do. The ECB has said they want to get, Trichet has said that they want to get their balance sheet back to where it was, I think, in the beginning of 2012, which would indicate about $1 trillion or a little more, perhaps, between $1 trillion and $1.5 trillion on their balance sheets. So if you take that as an indicator, then that's the type of money that we're talking about, the type of volume we're talking about when they might be announcing, and this would give you some indication of the market anticipates. Before today, I've read a fair amount of commentary that they're going to be doing $500 billion. The move today by the SNB is perhaps, Goldman thinks it is, an indicator that they're going to do a lot more than that. If they do a lot more than that, then that would drive the euro lower, and that would be an indication of why the SNB has chosen this. So there's two different things we're talking about. The 500 billion, excuse me, not million, is some sort of parameter about what the ECB may or may not do on the 22nd next week when they announce, or they may not announce, and if they don't, the euro is going to shoot up. What they're going to be doing as far as quantitative easing, about the purchases of sovereign debt in the European debt markets. The 20 minutes is simply what the price record shows of the price movement from the SNB announcement this morning. It does not imply any specific amount of deal flow. It's my guess, as I said a few minutes ago, that the deal volume was extremely low because nobody was playing. The only one who was out there, because I mean, even if you're, if you're here and you say, well, this looks like a good place to go long, and you pop into the market and put a bid in the Euro Swiss because you think it's a good time to go long, well, it went down another 15 figures after that. No prop trader is disposed to take that kind of risk unless it's inadvertent. You don't have at least in the banks, hedge funds, of course, have larger risk parameters, but you don't, and many of them trade foreign currencies. You don't have permission to trade that kind of risk. So anytime you get a move like this, one of the things that is playing into the volatility is the lack of liquidity, because there is nobody out there playing. It's far too dangerous. Okay, so let us look at some of the other effects of this glorious move this morning. Sorry, but this brings me back a little bit to my younger years when I was actually sitting on the trading desk. Moves like this used to be far more common than they are now. One, you had more currencies. There was no euro. Two, many of the banks really were intellectually, if you will, not fully weaned from the fixed rate system. In the 80s, you were only 10 or 15 years from the fixed rate system when people used to trade currencies by mail because everybody was tied to gold. This is back in the 70s and before, although it ended in 73. The currency system, as we know it now, took many years to evolve, 15 years, 10 years to evolve. And so central bankers in those days had a greater tendency to restrict the trading, to attempt to restrict the trading ranges of their currencies. They slowly learned it didn't work. They were still attempting to do it. The ERM is the greatest example of this, and the turmoil around the attempt, because there are two tools from a central bank point of view: interest rates and currency intervention. The SNB was doing currency intervention. They were buying in the market to try and hold up the euro and prevent the Swiss franc from appreciating. But you could also, and this was done with the Scandies when the ERM was around, you raise interest rates. So it's incredibly costly for a speculator to hold an overnight position. Both of these tools don't really work. And they certainly don't work when the currency markets, every one of the currency markets, senses an opportunity. One of the things I think that happened here is that the SNB realized they're going to know, I think, what type of volume is going through. I don't know if they'll have hard figures, but they'll have a sense. And if they sensed that the volume in the currency was building against them. Remember, there are many people out there who have much better information sources than I do, especially in Europe, for whom this peg was a golden opportunity. Okay, so let's look at some of the other fallout from this. First we'll look at, of course, is the euro, the US Swiss. A glorious move, a glorious day in the currency markets. I think the high was 1.02 essentially, down to 74. It's a 25% move, another 25% move. The euro we already looked at. Let's just put it up again briefly. This is a tick chart in the euro. Much less of a move. So you can say that the bigger move, of course, as you would expect, was in the Swiss franc. Why? Because the Swiss franc, let's take a look. Where's the Swiss franc? Let's put up a daily chart in the Swiss franc. Because the Swiss franc had been restrained since the summer, relatively speaking, moving from 0.9 to 1.2 because of the SNB peg. But that isn't the only thing that was involved. Take a look at the euro. I mean, this is the cable. The cable was great. I mean, the cable went down with the euro and then shot up. I did not bring the sterling, the euro sterling. I should have. What's going on here? The sterling is going and has appreciated against the euro because of the anticipation of what the ECB is going to do. So you had, now remember, this particular move is not specifically related to the sterling. But Britain's fundamental trade is, the majority of it is with the ECB, is with the EMU, of course, as you would expect. So you got this great speculative fall, then everybody took it back, and now it's back down to where it more or less headed in the direction of the euro. Why? Because so you have, this section here is a trading move, and this is the return to fundamentals. Because if the Eurozone and the euro is going to weaken, then so will the euro. So will the sterling. Okay, let's take a look at the dollar yen tick chart. Now, what's going on in the dollar yen? If the euro is getting weaker, but so is the euro Swiss, and the Swiss is getting stronger, this makes for a very puzzling chart. What's going on here mostly, in my guess, is the euro yen. As the euro yen collapses under the pressure of the euro, you also find a collapsing dollar yen and a strengthening yen. Because in order to sell the euro yen, you have to sell the euro and sell the dollar yen. And so the pressure on the euro translates into pressure on the dollar yen through the cross. And so that's why you're seeing, you also have some sort of attendant psychological pressure from the Swiss franc changing. You're going to have the euro, the Swiss yen going down. And if you have the Swiss yen going down, you're trading the Swiss, so you're selling the Swiss and selling the dollar yen. So these crosses are mostly about the amortizing, if you will, the movements generated. This is not a straight dollar move. You have the dollar weakening against the euro. You have the dollar strengthening against the euro, strengthening against the sterling, weakening against the yen, and weakening against the Swiss. And that is what we saw today. All of these moves of the charts that I've showed you are related. Just take one more look, and then I'll answer some questions if there are any more questions. This is a euro chart. Let me talk about this a second. Okay, so this is the euro. I think the big topic today is whether the euro, and does the euro still go lower? I think two things, and this answers your question right here, the last question here. If the ECB does only 500 billion, I don't know if it goes to 120. I think that the ECB is going to do two things. They're going to, the ECB's greatest success, in fact, has been, over the past couple of years, has been threatening the market but not actually doing anything. They've run out of the ability to do that. The ECB is perfectly happy. In fact, they're probably overjoyed to have the euro down at 116. They'd probably like it at 110 for all of the effect that it can give for European exports. Now, it's a far less of an impact than it might have been before the euro, which doesn't make a lot of sense, but it doesn't have as much impact as you think, because the greatest amount of trade for the European countries, the ERM countries, is intra-Europe. Germany's biggest trading partner is the rest of the EMU. It's not the rest of the world. And as far as that goes, it doesn't have much effect because it's all internal. Nevertheless, it will provide some support. In fact, the ECB has given up talking about structural reform within the European Monetary Union countries. It has no authority or real impact on any of that. Two questions here. If I have to wrap this up, I think, I tend to agree with you that I think the ECB is going to do less than expected. Every time they have come around to actually having to put numbers on things, it's always less than expected. However, the Greeks has elections on the 25th. It seems like the opposition party, Syriza, and Alexis Tsipras, I think it's pronounced, may win. Their policy, as they say, their program, is to renegotiate the bailouts. Will Greece leave the euro? I don't really know. I doubt it. But the mere speculation on it, I think September could easily drive the euro lower, even if the ECB only does 500 billion. I think they will delay. I do not think it will be June. I think it will be September or later. I'm not quite with Bill Gross, formerly of Primco, now of Janus, that they don't raise it till next year. But I am short of the logic for them to raise rates immediately. Okay? I thank everyone for attending. I know this has been a little scattershot, but I was attempting to illustrate what I thought was a fascinating display of central bank policy and its effect on the markets and how the markets work. I hope everyone found it useful. We will do the next webinar, as I said, on the topic which I had proposed for today. Again, I thank all of you for taking time out and for submitting your questions and comments to the chat. I always consider it a great compliment that people take time out of their day, wherever they are, to listen what I have to say and to pose questions. Again, thank you all very much, and we will see you in about 2 weeks. And thank everyone at FX Street for providing the facilities for these webinars. Again, thank you very much, and I will put my email address up there. If anyone has any questions or comments, please send me an email. Everyone, have a good day, and thank you once again.